Okay, let's unpack this. Have you ever, found yourself in that situation? Your business has a fantastic year, things are great, then boom, a really tough patch, maybe significant losses, only to bounce back strong again later.
Oh yeah, it's a classic roller coaster for so many entrepreneurs, small business owners.
Exactly. And the big question is, does our tax system kind of punish you for that volatility, or is there maybe a smarter way to handle it to level things out?
Well, there is, thankfully.
Good. Because today we're doing a deep dive into net operating loss, or NOL, specifically for individuals. We're going to explore what it is, why it even exists, how it actually works in the real world, and really what it means for you, especially if your income swings up and down or, you've faced a big unexpected loss.
Think of it as a crucial tool in the tax toolbox.
Definitely. Consider this your shortcut to understanding something pretty powerful. But before we dive deeper, just a quick reminder. This discussion is based on material from Farhat lectures. All the content, the examples, explanations, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So, whether you're an accounting student, maybe a CPA candidate, or are you a professional, definitely visit the website. They've got additional practice questions, video lectures, detailed support. Really helps reinforce today's topic.
Absolutely. Professor Farhat does great work.
A special thanks to Professor Farhat for providing this valuable material. Okay, let's get into it. Let's start with the basics. What exactly is a net operating loss?
Simply put, an NOL happens when your allowable business deductions for the year add up to more than your business income for that same year.
So negative business income, a loss.
Exactly. A financial loss for that year. And crucially, this loss generally has to come from a trade or business you operate.
Or sometimes casualty losses.
Or, yes, in some cases, significant casualty losses can contribute too. What's really fascinating here, I think, is the why behind it. Why did Congress create these NOL rules?
Yeah, what's the thinking?
It boils down to fairness,
Yeah.
really. It's all about preventing the tax system from, well, disproportionately penalizing businesses that don't have steady, predictable income. Think cyclical businesses.
Okay.
Let me give you an example. It makes it clear. Imagine two entrepreneurs, Adam and Avi. Now, over 5 years, both of them managed to earn a net total of $60,000. Same bottom line.
Okay, $60,000 net profit each.
Right. But Avi had the smooth ride. His business made a steady $12,000 profit every single year. Nice and stable.
Easy peasy.
Adam, though, his was a wild ride. Year one, $20K profit.
Yep.
Year two, a huge $160,000 loss.
Ouch.
Then year three, a big bounce back, $170K profit. Year four, another dip, $120K loss. And finally, year five, $150K profit.
Sweet.
Same net, $60K over 5 years, but totally different path.
Completely unstable income stream.
Exactly. Now, here's the kicker. If we calculated their taxes without any NOL rules, just taxing the profit years and ignoring the loss years for offsetting, the difference is staggering. Avi, Mr. Stable, pays just over $6,000 in taxes total over the 5 years. Makes sense.
Right.
Despite earning the exact same net $60,000, his tax bill would be over $66,000.
Whoa. That's incredibly different.
Isn't it? He's basically getting hammered by taxes just because his profitable years couldn't be offset by those loss years under that scenario.
So NOL fixes that.
That's the goal. NOL allows businesses like Adam's, with fluctuating income, to effectively smooth out their taxable income across multiple years. It means the tax system doesn't punish you just for having an unstable business cycle. You can use those losses from one year to offset income in other years' future years, and sometimes, depending on the rules at the time, even past years.
That example really drives home the point. It's about fairness. Ensuring similar economic outcomes over time don't lead to wildly different tax burdens. So, okay, an individual has an NOL. Where does it actually, show up on the tax return? And why does where it shows up matter?
Good question. It gets practical here. For an individual, the NOL typically first makes its appearance as a negative number on Schedule 1 of your Form 1040.
Schedule 1, that's for additional income and adjustments, right? Business income, stuff like that.
Exactly. So the loss shows up there. Then it flows through to affect your overall taxable income calculation. But here's a really, really crucial detail.
Okay.
An NOL is classified as a deduction for our adjusted gross income, for AGI.
Okay, for AGI, not from AGI.
Oh,
Why?
right.
Why is that distinction so important? What does that mean for you?
It matters a lot.
Yeah.
Your adjusted gross income, your AGI, is like a cornerstone number on your tax return. So many other things are based on it.
Like what?
Well, think about deductions like medical expenses, maybe certain charitable contributions, even some personal casualty losses. The amount you can deduct for those is often limited based on a percentage of your AGI.
Ah, I see. The thresholds.
Precisely. So when an NOL comes in and reduces your AGI before those calculations happen, it can actually help you qualify for more of those other deductions or increase the amount you can take.
So it's not just reducing the income directly from the business loss. It can have this ripple effect.
Exactly, a ripple effect across your whole tax liability. It sets the stage for other calculations. It's more powerful than just a simple line item deduction might seem.
Got it. That makes sense. So it's a powerful tool. But you mentioned rules changing and tax laws, well, they never seem to stay still for long. How has NOL evolved? Is it different now than it was, say, 5 or 10 years ago?
Oh, absolutely. The rules have definitely shifted, especially with major tax legislation in recent years. Understanding the timeline is key. Historically, a big feature of NOLs was often the carryback.
Carry back, meaning using today's loss to get a refund on taxes you paid in past profitable years.
Exactly. You could often go back a couple of years. But that's largely changed. For most new NOLs today, the carryback option is gone. The focus now is almost entirely on carryforwards.
Okay, so using the loss against future income instead.
Right. So let's talk about the current rules, the ones that generally apply to NOLs arising in 2021 or later. It's actually simpler in some ways now.
Okay, what are they?
Rule 1, no carryback. You cannot take a loss from 2021 or later and use it against income from 2020 or earlier. No refunds for past taxes.
Got it. No go back.
Rule 2, you carry the loss forward indefinitely. There's no time limit like the old 20-year limit. You can carry forward until it's all used up.
Indefinitely. That's helpful.
It is. But Rule 3, and this is the big one, when you use that NOL carry forward against income in a future year, you're limited. You can only deduct an amount equal to 80% of your taxable income in that future year.
Okay, not 100%. Only 80% of the income.
Correct. Let's say you have a $50,000 NOL from 2022. In 2024, you have $50,000 of taxable income before considering the NOL. You can't just wipe out that $50,000 income completely.
So you use the 80% rule. 80% of $50,000 is $40,000.
Exactly. You use $40,000 of your NOL carry forward. That reduces your 2024 taxable income down to $10,000, $50K, $40K. You still pay tax on that $10.
And the leftover NOL.
You had $50K, you used $40K, so you still have $10,000 of NOL left to carry forward to 2025 and beyond.
Okay, so it stretches the benefit out, but you don't get to zero out your income in a good year quite as easily.
Precisely. It's still a significant benefit, just capped at that 80% mark per year for these newer NOLs. Now, just a quick aside, there was a temporary blip for NOLs from 2018, 2019, and 2020 due to pandemic-related legislation. Those specific NOLs actually had a 5-year carryback option and could offset 100% of income.
Okay. A temporary exception.
Right, an exception. But for anyone looking at losses generated from 2021 onwards, it's the no carryback indefinite carry forward 80% limit rule that matters.
And even back when carrybacks were allowed, you could choose not to do it, right? Just carry forward.
Yes, you could always elect to forego the carryback period if, for strategic reasons, you preferred to only carry it forward.
Okay, that's a lot of rules and percentages. It feels a bit abstract. Maybe a concrete example would really help cement this.
Absolutely. Examples are the best way. Let's bring back John, a single taxpayer. Let's say his recent tax years look like this. 2021, he had $25,000 in taxable income, a decent year. Then 2022, business hits a snag. John incurs a $90,000 net operating loss.
Okay, big loss in 2022.
Then 2023, he starts to recover, $40,000 in taxable income. And 2024, things are better, $50,000 in taxable income.
Got it. So $90 K loss in 2022, surrounded by profitable years. How does he use that NOL under current rules?
Okay, step by step. The NOL is from 2022, so the current rules apply. Step 1, check for carryback. Can he carry it back to 2021?
No, right. NOL is from 2022, so no carryback allowed.
Exactly. He cannot carry it back to offset that $25K income from 2021. The entire $90,000 NOL must be carried forward.
Okay, full $90 goes forward.
Step 2, carry forward to 2023. John have $40,000 of taxable income in 2023. Now we hit that 80% rule.
Right, so 80% of the $40,000 income, that's $32,000.
Perfect. So John uses $32,000 of his $90,000 NOL in 2023.
Which reduces his 2023 income. He still has $8,000 of taxable income for that year, $40K, $32K.
Precisely. He still owes tax on $8,000 in 2023. And how much NOL does he have left?
He started with $90K, used $32K, so $58,000 remaining.
You got it. $58,000 of NOL carries forward from 2023. Step 3, carry forward to 2024. John has $50,000 of taxable income in 2024. Apply the rule again.
Okay, 80% of $50,000 income is $40,000.
And that leaves him with $10,000 of taxable income in 2024. 50K, 40K.
Correct. And the leftover NOL.
You had 58K, use 40K, leaves $18,000.
Exactly. That $18,000 NOL is carried forward indefinitely to 2025 and beyond, always subject to that 80% limitation in any year he uses it.
Okay, seeing it laid out like that makes the 80% rule much clearer. Even with a big loss, you still end up paying some tax in the profitable follow-up years. That's the practical effect. And remember, throughout this, his AGI is being impacted, which could influence other deductions as well.
That's incredibly helpful. It also really highlights something you touched on earlier. Figuring out your overall negative income on your tax return isn't quite the same as calculating the actual NOL amount itself.
That's a critical distinction, yes.
There are specific things that qualify and things that don't, right? So what kinds of income, or maybe more importantly, deductions, are excluded when you're figuring out that NOL number?
You're right. It's not just about the bottom line being negative. The IRS wants the NOL to truly reflect losses from your actual business operations or those specific casualty events we mentioned, not just, personal spending choices reflected in deductions.
Makes sense.
So when you're calculating an individual's NOL, there's a list of things you basically have to ignore or add back. You cannot use these to create or increase the loss. First, excess non-business deductions over non-business income.
Okay, break that down. What's non-business?
Think investment income like interest from a savings account or dividends. That's non-business income. Your non-business deductions might be things like certain itemized deductions that aren't casualty losses. If those non-business deductions exceed your non-business income, that excess difference, it can't create an NOL.
What about something like rental income? Business or non-business?
Generally, rental income from an active rental activity is considered business income for NOL purposes, so that's usually okay. Second big category, most personal deductions. This is huge.
Yeah.
Your standard deduction, big one. Contributions to a traditional IRA, alimony payments you might make. Most itemized deductions think mortgage interest, state, and local taxes. These are generally personal.
Why not include them? They reduce taxable income overall.
Because they don't reflect a business loss. The standard deduction, for example, is kind of a phantom deduction. It's not an actual cash expense you paid related to a business. So these personal items can't create or inflate an NOL.
Is there any exception there on the itemized side?
The main one is casualty and theft losses relating to a federally declared disaster. Those can potentially be included in an NOL calculation, even though they typically show up as itemized deductions.
Okay. What else is excluded?
You can't include NOLs carried over from other years. That prevents double dipping, basically using an old loss to make a new loss bigger.
Makes sense.
Also, capital losses in excess of capital gains. You know how you can deduct up to $3,000 of net capital losses against your ordinary income each year?
Right.
That $3,000 deduction, or any capital loss carryover beyond that, cannot be used to create or increase an NOL. Capital losses have their own carryforward rules.
Okay, separate track for capital losses.
Then there's the Qualified Business Income QBI deduction, Section 199A.
Ah, the pass-through deduction.
Yeah, that's another one of those phantom deductions. It reduces your taxable income, which is great, but it's not an actual business expense you incurred. It doesn't reflect an economic loss, so it can't contribute to an NOL.
Got it. QBI is out for NOL calculation.
And one final, really important point. An NOL cannot be used to reduce your self-employment taxes.
Oh, interesting. So even if your business has a huge loss creating an NOL, you might still owe self-employment tax.
If you had net earnings from self-employment before considering certain deductions, yes. The NOL reduces your income tax, but not your Social Security and Medicare taxes based on those self-employment earnings. You're still on the hook for those.
Wow, that's a critical point for freelancers and sole proprietors. Okay, so the core idea is clear. NOL is really tied to genuine business operations or specific casualty losses, not personal finances or certain tax breaks. This can feel like juggling a lot of rules. Maybe we can walk through one more calculation and put it all together. Let's bring Adam back, maybe for his 2022 tax year.
Perfect. Let's work through Adam's 2022 numbers and calculate his actual NOL. Here's the situation. Operating income reported, $250,000. Operating expenses reported, $290,000.
Okay, so right there looks like a $40,000 loss from operations.
Correct. That's our starting point. But there's more. He also earned $2,200 of interest income from a savings account. And he had a $5,000 capital gain from selling a piece of business property. That distinction is important.
Business property gain. What?
And finally, Adam claimed the standard deduction for that year. Let's say it was $12,950.
All right, so Income, expenses, interest, a business capital gain, and the standard deduction. How do we get to the NOL?
Okay, let's filter it. First, that core business activity. 250K income minus 290K expenses. That gives us the initial $40,000 business loss. That's definitely part of the NOL.
Step one, got it.
Next, the $2,200 interest income. Is that business or non-business?
Savings account interest. That's non-business.
Right. So for NOL calculation purposes, we ignore it. It doesn't reduce his business loss calculation for NOL.
Okay, interest is out. What about the $5,000 capital gain? It was from business property.
Good catch. Since it's from business property, it is considered business-related income for NOL. So this will affect the NOL. It reduces the overall business loss.
Okay, so the gain counts against the loss.
Exactly. And finally, the $12,950 standard deduction.
Personal deduction. Phantom deduction. Ignore it for NOL.
You got it. It cannot create or increase an NOL. We ignore it.
Okay, so putting it together, we start with the $40,000 operating loss, and then we factor in the $5,000 business capital gain.
Precisely. You take the $40,000 business loss and reduce it by the $5,000 business capital gain.
So $40,000 minus $5,000 gives us $35,000.
That's it. Adam's net operating loss for 2022 is $35,000. That's the amount he can carry forward, subject to that 80% limit in future years.
That calculation makes it much clearer how you have to specifically isolate the qualifying business items.
It really does. You focus on the trade or business income and deductions, plus any qualifying casualty losses, and filter out the personal stuff and non-qualifying items.
So wrapping this up,
Yeah.
what does this all mean for you, the listener? I think understanding net operating loss, it's clearly not just about filling out tax forms correctly, although that's important.
No, it's much more strategic than that.
It really seems to be about optimizing your financial health over the long term, especially if you run a business. It's about making sure you're not, unfairly burdened just because your income isn't perfectly steady year after year.
Exactly. It's a mechanism for fairness, allowing you to smooth out those inevitable ups and downs and weather the lean years more effectively.
A really crucial tax provision.
Absolutely. And it makes you think, as the economy keeps changing, business models evolve, maybe economic cycles become even more pronounced. How might the role of NOL continue to adapt?
Interesting question.
Could we see the rules shift again? Maybe different types of losses start qualifying or the limits change to reflect how people actually earn income in the future. It's definitely a dynamic area of tax policy worth keeping an eye on.
That's a great thought to leave people with. And of course, if you're looking to really solidify this knowledge, maybe you're tackling accounting courses, studying for the CPA exam, remember to check out farhatlectures.com. They have tons of practice questions, video lectures, really detailed support to help you master complex topics just like NOL. It's an invaluable resource for getting these concepts down cold.